All right, welcome everybody to Module 5 of our Price Action Principles Trading a Range series. This is the last written module, so you've now got all of the downloads from Module 1, 2, 3, and 4, and 5 now too. So this is the last video to go with it, but we will do a sequence for Module 6. We'll actually go and review each and every module in a live Q&A setting, and we can find some examples and really help people out. So we'll be sharing those details soon. Let's say perhaps even next Monday, and we will probably have a series of 5 perhaps of them and take it from there. So yeah, thanks everyone for tuning in. This one is trade management and psychology. So disclaimer, please pause the screen. This is purely for educational purposes only. There's no intent here to be giving you guys any financial advice by any means. You can just check out every single one of these little dot points. They're not limited to these. But look, I mean, it's the typical guff that you've got to put out there. So please don't interpret it as financial advice or specifically or explicitly mentorship as a one-on-one setting. Acknowledgement. So I would like to acknowledge these people. So the 2017-18 market, it gave me the hunger to learn, and it gave me an absolute ass kicking, as we've talked about, and you've no doubt heard me say now. Crypto Cred, without his videos and educational content, I wouldn't be here. These are what set me off down the rabbit hole of learning how to trade. We've got Trader Main, so he's got a Discord going, and I did find some similarities there, which was really good to see and reflect a bit off there. I don't know Maino personally by any means, but yeah, he's certainly out there streaming. He's got great charts. He learnt from ICT as far as is noted in his Discord anyway, but similar sort of background to where I came from, I feel. But like I say, don't know him. Yeah, seems like a decent enough fella. Rect Proof, so this man, he's a price action legend. With his public sharing of his information, educational content, etc., he's been just fantastic, and that's what really gave me the motivation to share what I have done here. And Emperor BTC, so he has been an absolute gem. There's no thanks that are enough. He gave me a voice to share my passion, helping me out as one of his mentorship students. There was 5 of us, and yeah, he really helped me out with the social aspect. So yeah, thank you very much. And Inner Circle Trader, so you'll know, you can see that a lot of these concepts, etc., are from Inner Circle. You can check out his free YouTube videos. He's actually got a mentorship at the moment for free on YouTube that he started. I do believe he's up to episode 5, so please go and check it out. There is anything that's not mine, I will happily make a disclaimer about and happily let people know straight up. So not here to try and steal anyone's thunder. So what's the goal of this course? It's to explore in depth each individual relevant puzzle piece that are, in my opinion, critical in gaining a framework of understanding with regard to price action trading, particularly trading a range. So as a recap, we'll be exploring the following. We've done market structure and Fibonacci. We've done order blocks and breakers. We've completed value area trading and volume profile tools. We've completed ranges and liquidity targets. That was an absolute beast of a module. And now this last one here is trade management and psychology, so this module. Then lastly, we have putting it all together, where we have briefly discussed that we will start to do a series of live streams as mindset, and we will cover this out as a group together. So with that being said, let's get into it. What's the agenda? So part 1 is trade planning and management. Determining a trading plan, our personality and timeframes, risk management, trade entry, profit taking and stop loss management, leverage, liquidations. Part 2 is journaling. Part 3 is trading psychology. So we talk about the Dunning-Kruger effect, behavioral bias, emotional market, the Wall Street cheat sheet comparison from module 1. Then we have some self-learning conclusion. So look, I've actually included this section here, stop loss management, but we did cover that greatly in module 1. So we'll just quickly reference it, and then we'll move on as we talk through the course. So trade planning and management. So I want to ask rhetorically, who here reading or watching this module actually has a trading plan? I do expect the answer to be a slight yes, but I can almost hear you nodding in agreement, but kind of just saying that you don't, but you do. If you do, that's great, but if you don't, here's some things that you should note. So your personality and your time frame. What style of trading is best suited to your personality? I mean, there's no point trying to fit a square peg in a round hole, so why would you do something that doesn't adapt or feel natural to you? If you like longer time frame aspects and you don't like the quick get in, get out aspect of scalping, then why would you do that? You've just got to go and check these things out. So which one are you? You're a scalper, day trader, swing trader, position trader, or a hybrid. So what time frame do you plan on trading on and the reason why. So each one of these, scalping can have its merits. In the low time frame, obviously, day trading 15-minute, 1 hour, perhaps 4 hour, swing trading 4 hour upwards, position trading day, week, month perhaps. So risk management. What is your predetermined max percentage of your capital that you're risking per trade? And how will you manage the drawdown on your capital and the methods you use to manage yourself in this situation? Trade entry, we talk about what your triggers for entry are, both long and short. How are you going to manage your trade entry? What minimum risk to reward are you aiming for? How to tally your win rate, and what minimum risk to reward you need to stay profitable based on your win rate. And lastly, here we look at profit taking and stop loss management. So how are you planning on taking profits? How will you manage your stop loss during your trade? Have you changed up your profit taking method based on the trading style you're adopting for this trade? And these are genuinely the things you have to go and ask yourself, because if you don't know these things, then you are asking for trouble. With that being said, let's have a look at the first one. So personality and time frame. So personality type. Have you ever completed a trading personality type quiz? So they can be quite odd to complete, but I'd highly recommend completing this one below. I don't have any affiliation with these guys by any means at all. I literally Googled it, found it, and it's dailyfx/research/DNA-fx/quiz. So my results are here on the side. And as you would all be aware, I do prefer the low time frame trades and setups. So go and give it a whirl, check it out, have a squiz, as we say here in Australia, and just work out what suits you best, because there's no point, if you will, to compare it to trading, I guess, there's no point trading against the trend. The trend is your friend, so if you work out what suits you best, then that is not even half the battle, that's most of the battle. So yeah. So here I am, I'm a scalper as it comes back as. I do like low time frames. I like 15-minute, I like 5-minute, 3-minute, whatever. I don't generally like hourly or 4 hour. It doesn't really gel with my style. So let's have a quick read. So a scalper is characterized by a very fast-paced approach to Forex trading or crypto. They seek to profit from short-term price swings, often by applying a rigid system based on evaluating price action. More often than not, a scalper will have a strict entry, exit, and risk management parameters, which are carefully calibrated to ensure that winning trades will always outweigh losing ones over time. Scalpers trade in a world of rapid-fire frequency and require strict emotional discipline to execute their approach, meaning it can be particularly risky, but it can also reap substantial rewards. Now, I didn't try and rig this. This actually did come out as a scalper straight away. I only did the test once. And funny, I had a feeling it wouldn't. That's what it came out as. So please don't be discouraged if what you think you are doesn't come up here. It's just a test. It's probably bullshit, but look, just work with what you've got. My only comment really in this respect is do what you enjoy. If you have a trading style that you don't enjoy, but it makes you a shitload of money, then that's cool. But what happens when you stop enjoying it and it just becomes a chore? I like the technical aspect. I like trying to work out breakers, order blocks, fibs, and just trying to get in really based on the price action of break and structure. Price rallies back up. So it's really retest trading, I guess, to a certain extent. But look, I highly and thoroughly encourage you to find what you like doing and then crack on with that. Trading styles. So there are 4 main approaches to trading with their relevant timeframes listed below. So I've given reference here to capitalindex.com. I'm not really too familiar with this website, but I just, again, Googled it and just checked it out. So we've got 4 trading styles: scalping, day trading, swing trading, and position trading. And the timeframes are short, medium term, long term. And we talk about here seconds or minutes for scalping. That's not really my jam. I do prefer the 5-minute to 15 kind of thing, which could be classified as like a hybrid scalp day trade, if you will. Day trades, we talk about 1 day maximum, so we don't hold positions overnight. Sometimes I do. So again, like it's you can build your rules, but just don't be a robot. Have your stops, your trailing stop loss, or your take profits and your stop loss to break even. Just have a plan, and that's what the whole gist of this course has been. Is that we've built you up, or I've built you up now. We collectively, you and me, have built you up so that you now understand how to trade market structure and what the triggers for those events are with Fibonacci. Then you've investigated order blocks and breakers. Then we looked at volume profile. And then we looked at ranges, targets, and liquidity. And we collectively, I wanted to build you up to that point so you've got the knowledge, but then you need this last little piece, in my mind, to make sure that you're warm and fuzzy. So that's why we're looking at this now. So we did get a little bit down the track. It was on purpose, but we will cover that later on. So yeah, please listen and adhere to to what you can from this course, because this will save you bacon. It's risk management and your trading plan. So as we talked about here, that's just a repeat, of the style over this side. So we'll move on. Trading the time frame that suits you. So now that you have an understanding of the trading styles and the time frames that roughly suit each style, it definitely pays to then go and assess which trading time frame suits your style. So if you recall, we explored the universal approach in module 4, where we covered that a factor of 96 can help with determining a range for the time frame you want to trade on. So that was called the universal approach. We looked at a 4-hourly chart, and then we started on a daily range. So we went from wick high to wick low, or low and high of the previous day. You draw a range like we've got here with the 0, the 0.5 and the 1, which is just a fib tool. Pull from the high to the low or vice versa. And then we looked on the 15-minute chart, and you can actually see there's a couple of opportunities per day on that 15-minute chart. So if you look at that and you divide 15 minutes into 24 hours or vice versa, then you get a factor of 96. So when we did that with the 4-hourly chart, it gave us about 5 hours, but I don't usually trade with the 5-hour chart. I like the 1, the 2, the 4, the 6 if I was going to use them, and then the 12 day and that sort of thing. The 5's a bit odd. You can use it. That's fantastic. Great. More power to you. But I prefer the 4 if I was to do that. And then using a range based on the 4-hourly, I would draw on the previous 4-hour a range from the top or the high to the low of that previous 4-hour, and then you jump to the 3-minute chart, which is the factor of 96, and then you trade that as a range. So you can basically use this method that we've learned and taught in this whole series on any sort of time frame. So if you want the 2-hourly chart, you can just draw a range from the previous 2-hour and then jump to the 1-minute chart in theory, because 4 divided by 2 is obviously 2 for the hours, and then 3 divided by 2 is 1.5. But if you wanted to trade on the 1.5-minute chart, fantastic. But that's just the power I wanted to give you, so you've got an idea. So based on this, it doesn't matter what type of trader you are personality-wise, you can still use all of the learnings in this course to suit whatever time frame works for you based on your trading style. So you should manage your trade on the time frame you enter as a note. So there's no point entering a trade here on the 4-hour, shorting here, and then managing on the 15-minute. It's just ridiculous, because you're going to start to shit the bed when you start to see any little jump up or down. So just if you jump and start on the 4-hour, manage it on the 4-hour. That's my advice. Risk management, probably the most key item in this whole course. So the intro. So when you're trading, risk management is key. Without it, you are simply gambling and throwing your money away. So I personally will never, ever enter a trade without a stop loss, and will always use a hard stop loss. So I don't use a soft one where you see price come down, it hits your mental level, and then you close your trade manually. Some people will let the level get hit and then run back up and close in a profit, saying, okay, look, fair and square. But sometimes, the risk therein is that price continues to run down and you just get your ass whooped. So I personally have a hard stop loss all the time. With risk management, you simply have to be able to understand these 3 things: capital and risk amount, how to calculate your position size based on these parameters, and then how you're going to manage your capital when you experience drawdown. So we're going to take a quick look, or not a quick, that's a bit of a lie, but we're going to take a look at these. The capital and risk amount. Where do you start with capital and the amount you risk per trade? It's all great and good and well that you say you've got 10 grand and you want to risk it and become the millionaire or whatever. The latest trader out there is doing a 1K to 10K or 10K to $1 million challenge. So it's not all swings and roundabouts, sunshines, lollipops, or nice smelling roses. Like sometimes the shit can smell, guys, and you've got to really work it out to understand and protect your capital, because there's no one else out there who's going to give a shit and protect it apart from yourself. So I cannot stress enough. So here we are. So for me personally, I will trade with 1% of my capital at any given time, generally with day trading or swing trading. If I change things up for scalping, then I may change things up to 0.5%. So of capital risk due to the quick succession of trades in this instance. So how does this look? Example to the right shows a 10K account, as we've got here. Equity risk per trade is 1%. So resulting capital to risk, or resulting equity you're risking, is $100 per trade. So you're only risking 1%. Now, if you're doing 3R, that's $300 a trade. But we'll go and look at your position size in a second. Now, with our capital here, if we're scalping, I should have actually called that scalping and then day trading perhaps, but anyway, then we're risking $50 per trade. So you've got here 100 trades because you're risking 1% before you completely break your bank. And here you've got 200 trades before you break your bank. So I'm not endorsing willy-nilly throwing trades out there till you have no account left, but we'll explore how we can protect that as well. So 1 of 5, how to calculate position size. So you can see that we're how much we're willing to risk per trade. So you need to understand that this is not our position size when trading. This is simply what we're willing to stump up for our great trading idea or the idea that wasn't meant to be. So if we look at this BNB chart, so Binance Coin or whatever it is, then check it out for our position size calculations. Remembering our initial risk that we accept in the form of 1% of trading capital. So if we take a look at this fresh position size calculator, then we'll tailor this chart. So here we go, number 2 of 5. So as an extension to the above where we explore percentage risk from capital, see the example on the right where we can now see how position sizing can work. So with the position size, this is calculated by your risk amount, so $100 in this case as we looked up the top, divided by the decimal conversion of your stop loss from entry is based on your long or short tool on TradingView or whichever provider you have. So don't panic because we're going to look at this a little bit further down, but look, so for this example, in order to risk $100 with a stop loss 1% away from trade entry, the required capital is $10,000. So if you entered this trade and you lose, you retain $9,900 less any fees you cop. So here we go. We've got working capital here. We have equity risk per trade 1%, resulting capital to risk $100. That's our risk amount. So stop loss distance from entry. So if it's 1%, that's where you get your figure from the long or short tool, which you only really care about the stop loss. It doesn't really matter about what you're trying to aim for. It just matters about the stop loss. So the decimal conversion of the stop loss distance is 1 divided by 100. So that's your distance away from your entry converted to a decimal. So we talked about that and we said 100 divided by that equals that. So in this case, you're using all your capital. That's quite a big deal. Number 3 of 5. So let's walk through this trade, okay? So let's say you've seen a market structure break, as we like to. We've seen one comes through here. This swing low has been violated by these candle closes. We had a wick, and then we had some candle closing below it. But we can already check here, right? How many times have you seen the last recent Bitcoin dumps? Now, wherever there's a wick like that, we come down and test it afterwards. So keep an eye down here, and this trade actually did end up going through, but regardless, that's not the point of this. We're trying to show you how to set up your trade. So look, the key item is the stop loss from the entry for position sizing. The final trade close or distance has nothing to do with calculating position size. So it all matters about this point here, where you would enter, up to this point here, where your stop loss is. So you can go a little bit above there. So that's 1.48%. Forget about everything else. 1.48% is what you need to focus on. The 3.53 is simply that times that equals that. If you drag this down here and this is the area you want to fill, that's great. That's 5.22% from entry. Forget about it. It doesn't matter. It's all about this section here. So you can see in this section, we have 1.48% as our distance from entry to stop loss, and we'll just note where we want to close the trade. So we don't care at this point in time. Specific example is given below using the calculator. So remember we had an example of 10K capital in our account. So we retain 1% as our equity we're risking just to keep it uniform. The result is $100 risked. Our stop loss is 1.48% from entry. So the decimal conversion, 1.48 divided by 100 is 0.0148. So when we divide 100, our risk amount, by 0.0148, our stop loss distance divided by 100 to get a decimal point, the result is $6,756.76. So this means that in order to risk $100, our position size must be 6756.76 based on a 1.48% stop loss distance. So if that grows bigger, then your position size decreases. If that gets bigger and closer, your position size must increase. Is that pretty clear for now? If it's not, we'll go through a bit more, but I do encourage you to perhaps watch this module a couple of times. Number 5. So in this figure of $6,000 is too much for you based on your trading capital. Don't stress. Sorry, if this figure. Sorry, I've just muddled my own words up there. But anyway, we'll cover this shortly in the leverage section further down. So we'll use this example too. We'll keep this one just so we can keep it referenced and relevant for you. Risk management, so capital drawdown. When we talk about capital drawdown, we're talking about you losing a series of trades in a row and then having a drawdown from your 10K in that example we just had. So if you lose 4 trades in a row at 4%, then you've just lost $400. So it doesn't sound like a lot, but it can be an absolute ass kicker, and you can go through some really bad runs. So let's have a look at the probability of losing trades. So one thing you need to be explicitly clear about is that trading is a game of probabilities. So in the table to the right, you can see the probabilities of losing X amount of consecutive trades within a 100 trade sequence. So if you see here from a 50% win rate, which we've got our win rate here, and we talk about that later on. So you can say we've got a probability of winning losing four trades in a row within a 100 trade sequence. So you can see that you can have a real shit luck here at 50%. Even if you win 1 and 2, you can have 4 losses in a row. And then as you sort of get further along, your losses, the probability of you succeeding or suffering, 10 losses in a row at 50% becomes still 1 in 10. Call it, let's round that 9 up, but that's pretty scary. I mean, 1 in 10 chance that you've just blown 10 trades in a row, which is 10% of your trading capital. So you've just thrown away $1,000 if you've just continually lost based on your method. So here you go. Now, if you've got a win rate of 5%, then you've really got a high level of potentially losing this many trades in a row. And if you have a win rate of 95%, fantastic, let me know what you're doing because I don't want to copy you. Then you've got pretty much F all, winning more than 3 losses in a row, so that's pretty damn good. Most people are around the 60% mark to 40%, so you can still see that even with 60%, you can still lose. As 1 in 100 chance you're going to lose 9 in a row. And I mean, this is, how many times can this happen? Let's say you lose 10 in a row here at 50%, and guess what? You win 2 more trades. It doesn't really matter. You can still then go to succeed or suffer losing 10 more in a row because the odds are stacked against you. So yeah, look, it's something to be super critical about. Be aware of it, and just know that most traders are between 40 to 60% in their win rate. So we'll cover that a bit further. Number 2, so the effects of drawdown. So see the table to the right. So this is the effect of faced from 10 trade losses in a row. So as you can see, the risk amount and drawdown are as follows. So 50%, by the time you've lost 50%, by the time you've suffered 10 losses in a row, you can see that if you're risking 50% at a time, which is absolutely crazy, then you've got $98 left. So yeah, that's pretty damn crap when you start to see that. So you can see that first one there, you've got 100K as your starting account. Then the next one, you have a loss of 50%, 50%, 50%. So when you see people, even with 10%, when they start risking 10%, if you lose those 10 in a row, you're down to 34 grand from 100K. And when people start risking 30% and 20% and they sort of start bragging about it, like, that's cool and that's awesome, like, great, fantastic. You'll see the results in the upside. But when you start to question and see this, you can see here for yourself that, you want to go lose 10 trades in a row, fantastic. We've got those stats in the above slide here. But when you come down here, like that person who's risking 20% of the time has now got 10 grand left. Like, what do you reckon their missus is going to say about that? The kids can't eat tonight because you've just gambled away. And that's literally gambling. But if you're risking 1% at a time, as we do, and as I'm teaching in this course, you start at 100K. As soon as you lose 10, you've lost 10%, which is 90 grand you have left. So that's quite palatable. But when you're risking 2%, you end up with a 19K loss or whatever that is, or 18.5%, 18.2, sorry. So you can see that it's not so bad, but I personally will never go for 3%, 5% or whatever. That's just, to me, it's too risky. It doesn't fit my risk profile. And it's up to you how you want to manage it, but this just gives you some perspective if you want to take the piss or have balls of steel. The next one is managing capital drawdown, so 3 or 4. So losses incurred versus gain required to break even. This is the crypto holders chart. It should be tattooed on your forehead. This can be brutal, but unfortunately in crypto, many will see losses like this, but will never see their investments recover. So this example to me is exactly why you should be limiting your losses with risk management to prevent instances of any of the examples shown. So you're in this game for the long run. You're not here to F around and just be here for an hour, a year, whatever. You want to be here for the long run. So they say trading takes 5 years to really master. We're all on our journey still. We're all in together. That's what this course is all about. So don't get sucked in to even buying spot without having an exit plan, because that is when you become community holder and you're in it for the long run with the 90% loss. So if you lose 10% of your holding or your capital, you need an 11.1% gain to break even. Then you look at 35%. you need to then jump up 53.9%. So let's say Bitcoin was trading at 30 grand, and then you lost 35, or say 100K, for example, then you lose 35 grand from it and it's worth 65. You then need that to jump up by an extra 50% from where it's at to break even. It's crazy. And then you've got 40% here, then 70%. So if you lose 70% of whatever it is you are holding, you need a 233.3% gain jump to break even. So look, just again, food for thought. Managing capital drawdown. So this one is this is the silver bullet, if you ask me. And this is something I did learn from ICT and on his free YouTube. So how do you manage drawdown? Well, one of the sayings that I do love to share with risk management is that you've got to learn to lose like a winner to trade like a pro. So think about that. You need to learn how to lose like a winner to trade like a pro. So that means that if you can cop losses, is an Australian term for experience. You can experience losses like a professional, then you're already there, because if you know that you lose a trade and you've risked 1%, then it's not really the end of the world, because we've just explored how that can affect your drawdown, your capital, etc., etc. But this concept can frame it even further. So the simple concept that I picked up from ICT is that you start off at 1% capital, so you're risking that each time. If you have 4 successive trades in a row that are losers, so 4% loss after risking 1%, then you cut your risk in half, and we can see it here. So your risk amount is 1%. Did you have a loss? Yes. Your cumulative loss, negative or positive, is 1%. You've lost another one, then another one, then another one. So that's 4% down the end here. Then you go, hey, hold on a second, like, holy shit, I'm really getting my ass kicked here. So let's drop down my risk profile to 0.5% or 0.5%. From there, you win 4. Let's just ignore the stats, probabilities, whatever it is. It's just for argument's sake. So you win 4. Now you're at negative 3.5. You didn't lose there, so you're at negative 3. You've won 0.5. You've won another 0.5 and one more. So then you've lost 4%, but now you're back to 2%. So then you get to your risk amount, 1%. You've just graduated back up after being demoted or relegated down to 0.5%. Then once you win half of what you've lost back, jump back up. So then look, we show here you don't have a loss and you win based on 1%. Now look, you nearly break even again. But if you kept losing this and it's a loss there, if you had won these at 1%, then fantastic. Like here, you'd actually be 1% up. But do you really want to deal with that psychologically? Like this is what we're doing here. This is all a trade management and psychology course. And if you have these things in place where you can protect your capital, because I tell you what, if you get to 4 losses, I've suffered 7 losses in a row before and it absolutely kicks your ass. So 1, 2, 3, 4, by the time you get here, you're kind of going, well, am I really cut out for trading? And you just got to laugh it off and say, well, hang on, like, yes, of course I am. I'm in this for the long run, so I'm going to reduce my risk by half and then keep cracking on. And then you can see here that you succeed. Now, we haven't gone any further beyond this because it's up to you to go and work this out and have a look at how this can affect you or hinder you, help you or hinder you, because some people might just keep cracking on and go straight through and charge through those 4 losses, 4 wins, one and go, hey, look, do you know what? I'm actually above board now instead of 1% loss. So up to you. But these are just the tools I'm giving and sharing from what I've learned that will hopefully help you on your own way. So we just talked here. So you maintain your half a risk percent profile until you recover half of the losses you took at 1%. So in this case, you graduate back up to 1% when you've recovered the 2%. And if you lose a further 4 trades at 0.5, so let's say you're really having a shitty week, that 0.5, you lose those 4. Cut it again to 0.25 and then do the same thing. So now you can see that not only do you have hundreds and hundreds of trades left in your kitty if you keep cutting things in half until you really work out your edge, you're laughing. And that is absolutely an edge in itself. The risk management portion of being able to cut your risk in half, in quarter, in an eighth, whatever, you keep going until you feel comfortable. And it's really empowering. It does suck to be losing. I've been there, but it's also awesome when you understand you're managing yourself, because all these rules are being put in place, and that's what we're trying to develop to protect you from future you. That future you is an awesome person, but can be an absolute dick. So you really need to make sure that these things are in place so that you can't trip yourself up in future. So you'll look back at this time once you have these things in place and you'll be thanking you in the past. So enough of the schizophrenics. I think we should keep on going. So please, if you're not sure, take a look at that and really study it. Trade entry. So with a trade entry, you've got to ask yourself, what sets you up to take this entry? So what are your triggers for long and shorts? Are they the same system? How will you manage your trade entry? Is it limit or market buy or sell? What minimum risk to reward are you looking for? How to determine your win rate. What is your win rate? What minimum risk to reward do you need to stay profitable based on your win rate? And then remember, we're setting up a trading plan here, so you do need to know these things. So it's not just me gas bagging for 45 minutes, or now it's actually been 30 minutes. Holy shit, that's pretty, that's taken a while. But all I can say is this is the key and the last keystone, if you will, of your, or capstone of your course, this, however you want to call it, study based on this, these modules. So this is the last little bit that you really need to hammer home, this section, this module. So trigger to trade and trade entry. So you may make a set of trading rules that dictate your trade entry. So this could be that you wait for a bullish or bearish reversal to present itself on the time frame you trade on. You then wait for a market structure break and then look to retest for an entry. If you've set an alert, you could then look to market buy into a trade after criteria that aligns with your goal is met. Or if you're time poor, you could set a limit order to get a trade. All I can say in that respect is limit orders can be, you don't have the luxury of, you can perhaps jag or snag price when it runs up, like that BNB trade we looked at where there was a quick wick up and down. But generally, my opinion or my perspective is wait for a trend reversal or a trend continuation to be entering trades rather than limiting. So I'll leave it up to you in that respect. So look, let's take a quick look at the recap of the rally concept that we explored in Module 4. So that's ranges, liquidity, and targets, as this serves as a great reminder of how you could potentially enter a trade. So I do apologize for regurgitating and recycling some content, but it's so pertinent. And there's no point teaching you one thing and saying, oh, hang on, let's go and check this out instead. So let's have a look. So the rally recap. So of course, there's no course without a cheesy acronym. So acronym, my goodness. That kind of aligns with some form of trading terminology. So rally, you've got a rally is for selling kind of thing, like that's the old wink, wink, nudge, nudge. So you're in luck. I want to introduce you to the concept that I kind of spitballed called rally. So someone asked, where does ICT talk about this? He doesn't. It's not some sort of godsend thing I've created. It's simply just an acronym that helps me out with my trading, and certainly has helped me along my way. So here it is. It's the RA comes from range establishment. So you draw a range first based on your universal approach, your market structure based or your time based. Then you have a liquidity sweep. So you wait for that liquidity sweep to kick in. Then you have your entry plan, and then you have your exit plan. So that's RALEE, so rally. So this has helped me out many a time when planning trades. So I'm an acronym nerd, but feel free to make your own. So just use this if you want as a mantra, or just whatever you want to do to help yourself out. It's cool. I don't care if you don't use it. It's just more as a trigger point to show you the process that goes through my mind. So the reason being is that I've seen many trades fail when I've stepped out of this process. So the probability of my trades then increases or is greatly enhanced when I'm waiting for a rally to play out. So more on this process in the following slides. So this is the entry plan. So we've skipped a few. We've missed the RA, the L. If you want to check it out, go and have a look at Module 4. And so entry plan 1 of 3. So if you cast your mind back to Module 1, we explored market structure breaks and trend reversals. And I'm showing here a superimposed image of a trend reversal, which is the swing low. We come down, we've got an a swing high, swing low that's been broken. Swing high to then a deep retracement, then up to support resistance flip, and then price runs up. So this area here is where you could perhaps be looking for an entry based on these parameters. So you've had a range that you've established, you've had some liquidity that's happened here, and now you're looking for the entry beyond the liquidity because you're kind of thinking, hang on, holy shit, like this might actually run back up now because we have some targets that we'll explore and all that sort of good stuff. So please refer to this. This could be part of your trading plan. It might not be though, so it's absolutely fine. So section 2 here, so continuing with the entry portion of rally, let's jump down to a lower time frame. So I did say manage your trades on one time frame, but to me here, I can't really see anything too appetizing for an entry. So if you jump down, you can see here it becomes a bit more clearer. So referring back to Module 1, we look for a market structure break. And we see that we've got a swing high here. Price comes along and breaks it with the fancy little asterisk there. So then you have several setups in this image in terms of market structure break, but we're focusing on the more high time frame one from this area, which you could actually call that there. That's the market structure break there. And then you've got the bullish order block down here, and then you can see price dips back into that order block. And then, there's another market structure break here. You could enter there, or wherever. So there's a few different options, but I'm being quite ambiguous here because it really should be up to you to have a look at what to do. All right, so the next one is the fibs. So we pull a fib from a low to a high. There's our asterisk again doing its thing. Then he comes down, and then we've got the optimum trade entry, as ICT calls it, the 0.72, or within this area. So on a higher time frame, if you've had you've had your range established, you've got your liquidity taken, then you see your entry based on the market structure break, and then you enter, off you go. Perhaps you target range high, but we will have a look at that in our exit section. So again, we've just looked at that, pull your anchor fibs, and price falls back into the entry levels in confluence with a range low. So what minimum risk to reward are you looking for? So sorry, I don't want to just quickly move away from this one too fast, but I just want to encourage you, if you're not sure on this one, please head back to module 4 to check that out. But really the premise of what we're trying to do is having a look at the range, at some entries where you could possibly enter on a trade. I just don't want to muddle you up with something that goes outside of what we taught or explored in the last module. So please bear with me in that respect. So what minimum risk to reward are you looking for? So this is one of two. With trading, you may or may not have an idea of what to look for that will satisfy you in terms of risk to reward. So if you don't, that's cool, but let's have a look here. Risk to reward, so what is it? It's actually basically the amount you're risking, and that's a terrible spelling mistake, I'm sorry, but amount you're risking from your capital compared to what you're aiming for reward-wise. So if we're risking 1% of our capital, remember the example that we shared previously on BNB, then this equals $100 based on 10 grand account size. If we want a 3-to-1 risk to reward, this means we want a $300 return on $100 risk. So that's our risk, that's our reward, $300. So in the chart on the right, it shows how this would look with your long tool on TradingView. And it's boiled down to where your stop loss is. So remember we talked about, forget about this section for now. Well, this is where the top section, if you're longing, comes into play. So the bottom section is your distance, so 2.39. Remember that's your position size to get from your $100. So that'll give you the amount you have to stump up to risk that equity. Well, now we're looking at our risk to reward. So here you're saying, well, hey, look, I think there's some structure over here. Perhaps we're going to beat. And now I'm going to pull my long tool up there to get a 3, and it coincidentally becomes a 3. Well, 2.39 times 3 is 7.16. So then that's what we explore here. So it's boiled down. So that's what it is. 2.39 from the entry to your trade. Then you're looking for a distance of 7.16 to achieve a 3-to-1 trade distance. So from there to there is 3 times as much as from there to there. So another example is the next one. This is a 2-to-1. So again, I just regurgitate some of the things in the previous slide, but what are you really looking for? So you've got to ask yourself, are you entering here at this point and then exiting above this swing high? Or do you want to go a bit higher? Do you want to then follow this uptrend as we've talked about? And you can catch these little moves as you go. Completely up to you again, but you've just got to work out based on your trading style, your personality, your approach, and what you do. Then you can then work out your win rate, which I think we explore next. So there we are, how to determine your win rate. Geez, I'm stuttering all over the place tonight, but I've got some good news. So it's pretty easy to determine a win rate. I don't mean to tell you how to suck eggs or tell you anything that you don't already know, but this is shared for the sake of completeness for the course or of the course. So your win rate is simply the amount of wins divided by your total trades. So in this example, you can see that if you win 1 out of 3 trades, your win rate is simply 0.33. So then this is in the journal as well. This will auto-calculate that for you as long as you're putting in items in the drop-down boxes correctly. Your win ratio. So all of these tools that are shared, they're in the journal as we just covered. So more on this further in the module, but in the meantime, let's take a look at something that is known as the win ratio and how now we've learned how to determine our win rate. So the tool auto-calculates what risk to return you need based on to remain profitable, when you're trading. So as your win rate increases, in theory, the risk to return needed to stay profitable will reduce. It's not something that I really use anymore because I understand what I'm looking for plans-wise, trading plan-wise, and what my risk to reward is. But I do encourage you to get your own head around this because this certainly helps out. So in here, what minimum risk to reward do you need to stay profitable? So once you've determined the minimum risk to reward that you find works best for you, you can then work out what your win rate needs to be in order to remain profitable. So the tool is outside of the win ratio tool above, where you manually enter in the value in the minimum risk section to work out what your minimum win rate is for the risk to return you're entering. So example, for a 2R, you need a win rate of 0.33. So if you have a risk profile 2-to-1, like we talked about in this section, then your win rate needs to be 1 in 3. So you have to win 1 in 3 trades to keep entering that size trade. So for a 3R, this would be 0.25. So the more you're risking, the less probability you need to succeed. Because if you're winning 1 trade out of 4, then that's actually break even, I think. If you're winning 1 trade out of 4, but you've got a 3 R there, then you're still ahead. I think that's the case. But yeah, go and work that out for yourself anyway. But you can use the tool. It's there for the taking. So don't be shy. So both examples are shown to the right, and this can greatly help in determining your trading plan. So if your minimum risk is 4, then in theory this comes down as well. So if this starts to come down here, so if it was a 1, then your risk rate would be half. Sorry, your win rate would need to be half. So you need to be winning 1 and 2 if your minimum risk is 1. So as this increases, it'll obviously come down. So kind of muddled myself up there a little bit, but I think you guys get what I mean. Profit taking and stop loss management. So big breath in. How are you planning on taking profits? Let's be honest now. Have you been caught out before where you haven't taken profits? You've gotten a bit greedy, or you have FOMO going on. You think there's just mass hype and hysteria as crypto's renowned for. Well, if you don't have those exit plans, whether you're holding spot or you're trading derivatives, whatever, you're just asking for an ass kicking. So there's no point entering a trade if you don't have a predetermined plan. This is how most people in crypto with their holdings end up losing it all, because there is no disciplined take profit regime that allows them to successfully exit a trade. It's as simple or as complex as you want it to be. So we can have a look here at recapping the potential take profit ideas from Module 1, Market Structure and Fibonacci, as well as Module 5, Ranges, Liquidity, and Targets. Okay, let's have a look. So potential take profit levels is the recap. So we've covered a bit of ground, so I'd encourage you to pause this because there's quite a bit to take in if you haven't seen Module 1 yet, but I'd encourage you to go and look at that. So here we've got take profit 1 at the 0.2A level, so you need to go back and check the Fibonacci setups that we will have. We'll look in the next slides anyway. Take profit 2 at the 0 level with 25% off position size. After take profit 2 is hit, you can actually bring your stop loss to break even, perhaps completely up to you. And take profit 3 possibly at 0.27, 0.618, take profit 5 at -1, and theoretical take profit 6 could go from a day trade to a swing trade. So with the above, there aren't any hopes and dreams. It's a structured, logical approach. So some people may not agree with this, but in my opinion, especially for those of you looking to learn to trade, this could really help in locking more profits in than you lose in terms of hoping that the trade plays out. So next slide, potential take profit levels is the bullish setup from recap of Module 1. So here we've got a Fibonacci level. This is a 1, there's a 0, you can just see it in there. It hits the swing high. This is on the 1 hour chart. Price comes up, hits the 0, or you place the zeros there. It retraces into optimal trade entry at 0.702. And then look, as soon as price runs up here, you've got an option of taking profit at 10% of your position size at the 0.28. At the 0 level, possible 25% of position size. So if this trade hits 0 level, when I'm trading this method, I could bring the stop loss to break even and then let the trade run. So further note, this is after 2 profits have been taken, not before. So once you hit that, if you bring your stop loss to break even, then you're already in profits and no one can take that away from you, providing that you're not gouging yourself with trading fees. When you get to the negative 0.27 level, you can get possibly 20% off. You can sell that. And then here another 20% at the negative 618. And then if you go for a full run up to -1, great, you've done a really good job. Fantastic. Pat yourself on the back. Close your trade. Off you go. Now what you can do as well though, we didn't talk about this, but this is a little extra. If you get to the 0.27 level, then what's stopping you from bringing your stop loss to 0.28? And then if you go to the 618 level, what's stopping you from bringing it to the 0.27? So you can see here that if you were to do that as a trailing manual stop loss, you can trail yourself up. Here you would have taken profit 1, profit 2, profit 3, and let's say you brought your stop loss up to 0.28. Then you go to 618 and you actually bring your stop loss up to 0. Then you can see if you had actually brought it up a bit earlier, so I'm kind of contradicting myself, but you get it, is that if you had brought up your stop loss to 0.27 after it hit 618, well then you could get stopped out. But if you were still down here, and then you hit 618 again, then you could keep it going. But actually it does look like it went and hit 1 first, so you would have almost smashed that trade completely. So you would have been stopped had you trailed it, but before doing that, you probably would have closed the whole trade out. So I hope that makes sense. I kind of just spatball that one, but please watch it again and it will make sense. Bearish setup. So here we are, we've got a 1, we have a 0, we have a market structure break here, so we're looking for a short. Price comes up, hits the 702, and then you have a repeat of the possible take profit of 10% position size here, 25% of position size here, 20% here, 20% at the 618, and then 25% here at the -1. So again, if price hits the 0 and that really does like close and that whole candle body goes through there, so you could be straight away, you're up to stop loss at break even. And then as you keep running down, you just have your trailing stop loss at one of these fib levels behind, if you so wish. Completely your call. Again, like they're my favorite terms, if you so wish, completely your call, but it really is. This course is just giving you the tools for you to go out there and kick ass. So potential areas to take profit. So this is a recap of module 4, and this is the exit or the last E of the rally concept. So here we've looked at 3 types of take profits or potential targets in module 4. So please go and check that out. And we've got market structure based, fair value gaps, and also volume profile based. So here we've got price ran into our asterisks as we looked at, and now it's running up. So where are you going to start to take some profits? So here you can see there's some buy side liquidity / partial objective above these old highs. So that's market structure. And then here you've got it above the range high. So this is the above the recent swing highs where stop losses will be resting in the form of short sellers. And then above range high where we could typically expect liquidity to be further resting. We've also got some fair value gaps here. So remember, a fair value gap is where an opposing candle, a candle trades through, engulfing, if you will, some will call it that. But if the gap becomes apparent when the candle of the opposing style or method, or however you want to call it, is it's not until the next one down. So really, had we drawn it from here down to here originally, you would see it would get filled up to here. That's why we've drawn it from that last up candle, down to that wick of the darker candle here, the down candle. So that is, in my opinion, it's closed up to where the box is now. So if you were to aim for this target, you want the rest of the fair value gap filled, then that would be how I would do it in my opinion. Up here, you can see the same thing we've done again. There's an up candle here ever so slightly, and then we've gone from the wick of that one up to the wick of this one, but I have actually left a smaller gap here so you can actually see the range high, so it's not confusing. Then we have got volume profile targets that we looked at. So you've got a value area high here, and you've got a value area low down here. So you're down beneath value area low, which is generally good for a long position. But again, it depends on the criteria. You have a point of control through here, which you could potentially use as a take profit. And then you have a value area high here, which again, you could use as a take profit on the way up to range high. And you can see here that the distance between the point of control and the value area low is semi close to the value area high and POC, but you can also see that to center to that. They're almost equal. So there's a sequence there that you can actually do that could perhaps help you out. So on to the next one. And then you got your volume profile targets with the VPSV. So down here we had our entry here, and you've got some naked points of control up in this realm, which is above range high. So you could potentially target them if you're feeling quite confident. You've got a really strong conviction, and that's great. But we'll have a look down here. Sorry, we didn't cover it, but it did strike it. So the result was that I do recall that the result was that price carried on up, and it did end up taking out the NPOC. So it hit all of these things. It hit the liquidity objectives, it hit the fair value gaps, and it did close out the naked point of control. So if you're going to change up your profit taking to suit your trading method, in this example, we simply adopt a new profit taking method for a different style of trade. So here on the 15-minute chart, let's say that instead of a day trade or a swing trade setup, that you just roll with entry based on fibs, and that you simply want to beat each previous swing high or low depending on your setup. So we're literally fib from the low to the high, down into your optimal trade entry, and then you're just aiming for that 0 there. So you've got an entry here, and you've got an exit up here. Same thing down here. You might just want to enter, once you see the price, you can actually do it here to be fair, up, down, and then beat this section. But then that's just generally what you can do. So you might not want to take any profits at all. Or you can perhaps take profits at 0.28, bring your stop loss to break even, and then hope that you're going to run up to the top. But again, your call. Leverage. So leverage is not a dirty word. So for me, it's a tool. And a lot of new traders will get scared. They'll get weary. They will and can be a bit worried. And that's fair and reasonable, because there's a there's liquidation at the end of it that can really bite you in the ass, and you'll lose your margin. So let's explore this, because I don't want people to be scared of something that could potentially help them. So it's a tool, in my opinion. It's not a sin. So it helps me keep large amounts of money off exchanges and in my own control. My perspective is that it offers me the ability to enter larger positions with small equity utilized. So that's what it's for. But there's lots of folks out there who are just flat out against leverage. But as long as you use it responsibly and ensure that you stop it well above your liquidation level, then for me, it's all good. For you, it's up to you to learn how to get into it using these methods. So if there's anyone out there harping on about entering a leverage position without a stop, for me, that's an absolute no-no. So enough carrying on about it. Let's take a look. So do you remember that chart earlier where we explored the position sizing on BNB? Well, if we take another look at it, but let's have a look at it this time with leveraged view on it. So here we are. This was the one. Leverage, BNB, no leverage spot example. So that's kind of confusing, but we're looking here in this particular location. Leverage is 1. So if you had 0 leverage, then you wouldn't have a trade. So it's 1. So with the chart above, we can now use a more advanced calculator, which will be generating the position size, and we add in the following: equity risk percentage, leverage, entry price, exit price, stop loss. So that's yellow, 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 yellow. So you enter those things in manually. You'll see that by entering these, you get a figure of 6755.172. This is just about the same as the above example we shared. So I'm not going to go back up to it, but it's generally spot on. So this does not have leverage applied to the calculation. We'll check that in the next slide, but don't worry about copying this because I'll share this as a calculator in the journal. So you would have already seen that perhaps. If you haven't, it's in the link. So this is BNB with a 10x leverage example. So there's the 10 now we've entered. So if you see down here, the max position cost is 675. Down here it's 6755. So 6755 divided by 10 is 675. Now what you do here is you have the same equity, you're risking the same amount, you have the same entry, exit, and stop loss. But now what you're doing is your potential gain, it also doesn't change, and your loss doesn't change. Neither does your risk to reward ratio. It just means that you need to stump up a certain amount to be able to then trade within those figures, but it's not spot. So you don't get to keep the contract for difference or the future or the derivative that you're trading. What you essentially have contracts which are representative of the price from spot. So you don't own the underlying asset. That's something to be really critical of. So with this chart, again, we've entered equity risk, leverage, entry price, exit price, and stop loss. You'll see that by entering these, we get a figure of 10, a factor of 10, so 675.52. So employing the use of 10x leverage, your position size remains the same, and so does the potential wins and loss. There is no change to the risk to reward ratio. So the position size doesn't change, but yeah, you have that ability to use less equity to be able to keep it off exchanges. So the thing that you have to be critically aware of when entering a leverage trade is your liquidation level. So how do you work this out? Well, let's take a look below. Liquidations. So the process. So this is, I screenshotted this from Bybit. So this is the part that sucks with leverage trading. So you can definitely get liquidated when trading with leverage. We're going to explore this process using Bybit's terminology, as I both trade there and I do work with them. So let's take a look at a couple of explanations. So Bybit uses a mark price to avoid liquidation caused by low liquidity or market manipulation. So under isolated margin, you can check when position margin decreases to the maintenance margin level, the position is liquidated. So if the trader holds long or short positions simultaneously under isolated mode, it may happen that both positions get liquidated under extreme market movements since the long and short positions are independent. Under cross margin mode, when available balance decreases to 0 and position margin decreases to maintenance margin level, the position is liquidated. Please take note that when holding hedge positions of both long and short under cross margin mode, only the net long or net short position may be liquidated. A fully hedged position will not be liquidated. So if you're not sure of those terms, please Google them, have a look. Yeah, it can be a bit to take on, but it's not super confusing. So how is it calculated? So here is directly from Bybit, the actual the way they roll through this and how they work out your liquidations based on your parameters of entry. So I'm not going to read this out because I'm almost sick of hearing my own voice already, but please pause the screen, take a look or review this as you go. But what I want to do though is not being flippant about avoiding this, because you can go in there and you can make your own calculator based on this 100%. But what we want to look at is how to then protect your ass from being liquidated. So how do you essentially do that? Let's take a look at this setup on Bybit's actual interface. So first, detailing the entry parameters from the chart that is shared into the Bybit console. So we're still respecting the 10x leverage and also the $100 risk position that keeps things uniform. So we've got there's our stop loss, 397.6. That's our entry, 391.8. And this is our exit, 371.35. And you can see here, order price, 391.8. We use that. And then we have here, take profit, 371.35 right there. Then we have stop loss, 397.6. Now what you've got to do is muck around with this section here to get to your area that then tells you how much you're going to be risking. So there's your gain, potential gain, and there's your potential loss. So when you then go, after you've entered those parameters in, click on the calculator, this dialog and screen here opens up. Go to the liquidation price section, go to short because that's what we're entering here. And then you enter in those parameters. We've got 10x, that's what we're looking for, leverage of 10, quantity of 17.25 that you use after you've determined, you muck around with this figure here to determine what you want down here. And then your entry price is 391.8. So we talked about that right there. Now the liquidation price is 427.06. Now our stop loss is 397.6. So we are well and truly, we are $30 out from being liquidated, or $29.24 or whatever it is. So you've got a fat amount of room before you have to start to worry about any of that. So you know that this trade is safe, providing that you have your parameters in place. The most you can lose is $100, excluding fees, and if you select a trigger order perhaps for sale, which will then, once prices hit, market trigger it's triggered to market sell rather than limit order. So again, that is how you then protect your ass, cover yourself. You do that measuring twice, cutting once, and then you look after what you need to do, which is your capital. So please read this, study it 4 or 5 times. This will really save you bacon. Journaling. So this is the journaling portion. For me, journaling is one of the most important things in trading. It basically lets you develop a data set on you, and then it lets you allow your strengths and weaknesses to be utilized to your own advantage. So it's your own Spotify playlist on you as a trader. It's your own data. It's what you're putting in. It's so powerful. So without carrying out the simple tasks, the current and past you is disadvantaging the future you. So we talked about the schizophrenics earlier on. Well, they're back. You know, you've got 3 yous. You've got past you, current you, and future you. So the past you has to enter this information in, or have done it, so that the present you can assess what you are best at doing, so that future you will benefit. So it's quite convoluted and quite funny and almost quite stupid to say it like that, but that's the reality of it. So I've managed to build a journal that I do like now. So I've been at this for a little while. So this is shared as a Google Doc sheet as well. So you're more than welcome to get it, but please, as a note, don't try and request access, because if you did get access to it, editing rights or whatever, then other people will suffer if you are entering things that aren't quite nice or aren't intended. So please don't be disrespected if I don't give you access. Just simply download it as an Excel spreadsheet. So you're then free to go and do whatever you want with it once you've downloaded it. But here we talk about a couple of things. So there's 1, 2, 3, 4 tabs: rules, position size calculator, so that's spot or no leverage. Then you have a trade tracker, which is this screen here. And then you have a position size calculator advanced. So we'll take a look at each one of these. So the rules, this is what we're doing in this whole course. This module particularly is building up here to enter your own rules, and then use the journal to track the trades that you've used the rest of the information on the modules on, to then go and kick ass. So as an outcome, this particular module has been created so you can build your own trading plan based on new concepts mixed with a dash of previously explored topics from previous modules. One key item as a foundation block for your trading plan is and are rules. So the first tab of the journal explores the below. So you're welcome to change these. These are just something that I had from a little while ago. And I've since moved on with some of these rules, but that's what they're all about. And you can see that with the traffic light system when we go into the module, into the journal, that if you can see many traffic lights, some reds and ambers flashing up that aren't gelling with the particular trading style or the rules you've put in place, then that's just a trigger. You're not a robot. Go and change your rules up to suit what works for you best, because there's no point trying to push shit up a hill. You need to get out there and work out what's best for you. So the first tab of the journal explores the below. So you're welcome to change it, as we've talked about. We've got trading style and personality. I've now given you the tools to go and work out your trading personality and your style. So enter that in here: scalping, swing trading, position, whatever it may be. Then you have your timeframes. So put them in here as well, based on your personal preference and your personality style. So 4 hour, 1 hour, whatever it is. Then you have risk management. So if you want to put here, capital risk at any given time is 2% max. That was my old version. So I only wholly and solely risk 1% at a time. So if capital drawdown occurs, this is when we talk about protecting your assets, then drop to 1% or 0.5% accordingly until 50% of the loss has been recouped, as we studied before. So always use position size entry on futures to determine entry, stop loss, position size, and this should actually say liquidation level. So the trade entry, I've got some old preferences here. So never enter unless trade setup presents itself. Minimum 2 to 1 on all positions, ideally 3 to 1, one trade at a time. You see people with 20 trades open, great, have fun managing. I just do one trade at a time, that's it. So map out your key levels of support and resistance, and entry must be based on the 13 and 21 EMAs. That was something I picked up from Emperor, but that was a long time ago. So up to you guys, again, how you want to roll with this. But again, I did mention one trade at a time. There isn't, to be fair, anything wrong with doing more than one, but I think that more than two is kind of crazy. Not my thing, not to say it doesn't work, but some people may disagree, and that's cool. I fully respect it. So whether you like it or not, I guess we've talked about profit trading as well, so scalping or intraday. And whether you like it or not, we've actually covered all of these things in this module already. So whether you've wittingly or unwittingly been aware of this, here we go. We've been through every one of these, so there's zero reason now why, using what we've explored up above, that you can't go and do your own rules based on and put it on the front of the spreadsheet. So that's my gift to you. Position size calculator, this is tab 2. We've talked about this one. There's no point in going through it again. You've got it back here. It's more of a reference for completeness of the course. The trade tracker, so 1 of 4. So there are 3 parts to this trade tracker. One is the data capture section, which I've highlighted here. The next is the debrief, so your actual comments. And then the last is the traffic light system, which we'll cover as well. So all are shown on the right, and we'll also take a look at these individually. So the data capture section, I will actually tab across from this one to check it out. Data capture. So here we go. This is on the Google Sheet, and it's great to see there's actually an anonymous cheater, anonymous quokka, which are actually WA based, funnily enough, and anonymous lemur. So they live on a little island called Rottnest Island, the only place in the world. So it's cool to see that actually. All right, so we've got here win, loss, break even. These are a bit stretched out as well from where this transferred from Excel, but anyway, that's cool. So win, loss, break even, you simply click on win, loss, or break even, and then you'll find that the items are tabbed down here. So losses, wins, and total trades. I'll just close this guy up. And yeah, trading pair, Bitcoin, USDT, whatever you want to do there, long or short. So you can put a short there. Your method, I haven't put drop downs, it's up to you. Same with the 4 hour, 3 hour. With your screenshot link to TradingView, you can simply just go take a photo. So you can pretty much say copy link to the chart image. And then if we jump into here and we just go like so, there you are. That's how you do it. And then you don't actually have to save any images within here because it can chew up a lot of data. And you just simply click on that and copy link, go to the new page up there, and you'll see that our chart then gets spat out exactly how we had it. So that to me works quite well. I'm pretty happy with that. The date, you can put the date on there and you can see I did this one a little while ago. Purchase time, sell time. This really helps with working out about you. What are the best times that you're winning on? If you're winning at the average of sort of 2 p.m. your time or whatever, then why would you not trade during that time? And what's the best time you're selling, so to get out of there. And then you can also work out your losses, like what are the worst times for you to be buying in and losing a trade, and then you just avoid those times. So your risk to reward, you can use this as a monthly handy tab. Leverage, that's really for Forex. So you can put 30, 20, 10, 200, whatever the case is, up to you. Your equity required for the trade, so that comes from your position size here. And then you've got your order value, and then you have your next trade risk. So remember the graduated section we talked about? You're more than welcome to go through here and go 1% again, 1, and then you're going to go, hey, look, I've been kicking ass so much, I'm whipping my balls out, and we're going for a 2%er. So there you go. And then you go, I've had a loss, or you might want to go for 2% if that's your trading method and your style, or you can go for 0.5%. It's just a trigger, really, for you guys just to check and make sure you're happy. Then you enter your result, and then you put in your fees as well. The fees are auto-calculated up here, so that it's simply the sum of were to go times -1. There's your net profit because you've had fees, and then you can just spit that out at the end of the month. The next one is, let's just jump back to our handy dandy course. Trade Tracker, the debrief. So here you just need to be open and honest with yourself. Let's check it out. So I did originally have some drop-down selections actually, but they didn't copy across. That sucks. But I did have a few things. So, oh no, sorry, I didn't. Beg your pardon. I've just muddled myself up. This is where you do enter your actual comments. So put in, if you traded your plan, emotions when taking the trade, what did you do well? What can you improve on? And what are some feedback and notes to yourself? Now on the course, you can see that I do write one thing here. Now I've got, I struggle with just going over things that I don't find value in, or I shouldn't say that because these offer insights to yourself. I personally do much better looking at these colors. I'm very visual in learning. So when I have a novel written here, you can go back over a couple of beers, perhaps one day, or a coffee to have a bit of a laugh at where you were. But I much prefer looking at these items here, so I can go, right, hang on, look, I'm getting in pretty well, but I'm not managing my trade too well because I'm getting emotional, or I've got FOMO, or I'm just worried about losing money. And then your feedback to yourself is the overall, is it good? The rules weren't followed. And then once you start to see, let's say you get a few of these, you stepped outside your trading plan and reassessing your rules. Let's say you get something like that. You had a no, I didn't trade my plan. I was pretty cool, calm, and composed. I stepped outside of my trading plan, so I didn't do that well. I need to reassess my rules, and my rules weren't followed. So if you get things like this, and by the time you get down to here and you've got a whole bunch of reds, then you know something's wrong. So this can help you mentally as well. If you're getting a whole bunch of greens, it's just a trigger mentally for you to say, hey, do you know what? I'm actually doing quite well with what I'm looking for in terms of following my rules. But then if you've got yellows, then you know that you can perhaps then go and change things up. Or if you've got reds, then you know you need to give yourself an ass kicking. So this works for me much better, but I do digress there. But so yeah, there's some trigger points here for you if you want to use them, just in terms of what you would actually put in. Now the traffic light system, as we've just covered, so I've preempted some prompts for you. Change them up as you need to do. If you're great with Excel, that's awesome. But if not, just look it up on Google or whatever, how to change the data and the list location. Yeah, and we have covered this quite extensively, so I'm not just going to read them out again because it's my voice is going, but the more green, the better. The more orange, the trigger there is you've got to start to look at what you're doing. And then the more reds, you know there's something going wrong. So you can already get 10 trades in and go, shit, you know what, I've actually got a few reds here. I need to change something up, because there's no point persevering in the face of adversity if you're not striving for excellence. So that's one of the most cockiest sayings I've ever heard from a real wanker of a guy once, but it just stuck. So it's all for a bit of a laugh. The advanced calculator. So this is on the third tab, fourth tab even. And this is something I did find in Trader Main's Discord. There was actually an Excel sheet that had a whole suite of different things on there, but I did take these two things from there as something I found value in. So I've used them here, I've adopted them. I'm confirming that they're not mine. I didn't design them, so please don't think I did. And the only thing I did on this one was I did design this little thing here, which is the scaling off comparison, which we can look at in a second. Okie dokie. So coming back here, so we've covered this calculator above, but there's your long version, there's your short version. So again, you just enter in the yellow sections there. Sorry, that actually shouldn't be covered yellow, but it is what it is. So make sure you measure twice and cut once. So there's no point in not having the relevant information in there, because it's garbage in, garbage out. So again, I mentioned here, I found where these were originally from. Go and check out Main's server and Discord. There is the actual full sheet you can get there, which has a whole larger raft of things, but I just wanted to tailor my own thing. And then the advanced calculator. So we've got the scaling off calculator. So when we talk about taking profit, so I'm just going to jump back up a few levels here, guys. So apologies for the for moving on. But we just have to go up a little bit higher. So when we talk about taking profits in this section, this is what the calculator is relating to. So you can actually measure from your entry point down to this location. You need to check the risk to reward based on that. And then the relevance from your entry to there if you sold at that point, which will then give you a spit out version of your updated risk or to reward. So let me just get back down there because I'm rambling there. So you can see here we've got the target of 0.24. That should be 0.28, but then you've got profit taking levels, so you're not taking profit in that respect. The risk to reward is 1.35. If you're staking $100, you're not taking profit at that 0.28 level, so it's okay. If your target is 0 on the fibs, then and you want to take 30% off, your risk to reward is 2 to 1. So equity staked is $100. So you go O times M5 times N5, which you can see on the sheet, equals your result. Same for down here. You hit the negative 0.27 level, you take 30% off. Your risk to reward was 3 at that level, and then you just times $100 times 3 times this factor here, and then that's the profit you have received at that location if you sold. Same for down here, same for down here. So you can see here that you've got a total of $326.40. In this section here, this is the comparison from the long tool to the scaling off comparison if you were entering along. And you can see down here that your potential gain would have been $443 using the same parameters had you just not taken any profit along the way. So ignoring what we had shown in module 1 without taking profits, if you rode the whole trade all the way up, that would be your result there, 443. If you had decided that you wanted to take profits along the way, you have a result of $326.40. And the difference from full trade to scaling profits is negative 117. So great for all you Halo fans out there, 117. But that's your difference. Would I rather have 443 or would I rather have 326? So 117 less, but locked in all these profits along the way. Well, I think you guys know the answer. I like to protect capital. I'd rather keep the 326 and cop the $100 loss compared to this factor here. But some people might want to ride things the whole way. So when you have you enter your trade and your R to R is 4.44 based on this situation, your actual result becomes 3.26, which is simply if 443 equals 4.44, then this equals 3.26. We use the $100 for an example because it's just easier to work with. Trading psychology. So when we talk about trading psychology, it comes down to one thing only, and that is really how you manage yourself in a given trading situation. So you might be squirming in your chair if you've entered a position. You might be scared to take profit because greed gets in the way. You might be fearful to enter a trade due to loss aversion from too many losing trades. It doesn't really matter. That's the basis and the crux of it. The reason you feel uncomfortable, out of sorts with the trade is based on one thing and one thing only. You need to develop and determine a plan for yourself that you religiously stick to so you can manage yourself when you find no one else other than you in the situations you just mentioned. So no one else has pulled the button, the trigger, pushed the button, whatever. You have entered a trade. If you've entered it without a trading plan, then who can you really blame? If you're following a cartoon character on Twitter, I really can't help you, and we know we've all been there, but the reality, like I keep saying about this course in itself, is that it's to give you the tools you need to succeed. So you shouldn't have to blame anyone in the future. There's no one to blame but yourself. So there's a Dr. Jekyll and Mr. Hyde in everyone. And for those of you who aren't familiar with that, just Google it. It's an old character where there was a nice person who then turned into the Mr. Hyde. And one was really nice and one was quite evil. So look, you've got to make sure that you have rules in place to keep the future you from fucking up your future profits, or ensuring that future you protects your capital with strict risk and loss management processes. It's so funny how you can look back at that guy or that girl a month ago and you can kind of give them the middle finger going, what did you think you were doing? But then the you now is like, oh my God, you're high and mighty. But then future you're kind of like, that future me better look after me because I'm going to kick their ass if you don't. And it's kind of funny to speak like that in schizophrenic ways as we do. But the reality is that you've really got to protect you from you. So if you enter a business arrangement with someone, and I have done this in the past, you have things in place to protect you guys from future you. Because if someone gets a bit jealous or gets greedy, the business starts to fail, whatever, you have to have these things in place to protect yourselves from yourself. And when you look at trading like a business, which you should be doing, then you need to have a contract in place with your rules in hand that protect you from you. So look, that's kind of enough, I think, in that respect of referring to ourselves in the third person, sounding a bit crazy here, but that's really the gist of it. There's no one else to blame but you, so you have to make sure you can't undo you. That's it, I'll leave it there. So look, we've covered all of the above in this already in this module, but this section is really to get an understanding of some of the issues that you can face from a psychological perspective. So the Dunning-Kruger effect. Now, put your hand up if this is you. You've started trading. You might have bought Bitcoin. It's gone skyrocketing. You got in some Luna at some crazy price, and price is just running up. This is fantastic. The confidence you have is huge. You think you know the markets, and I've been there myself. You think, what does this person know? What does that person know? Guess what happens? Shit hits the fan and price runs straight back down. Then you end up down here going, oh my God, look, I've made a big mistake. And this is where most people start to learn how to trade. me included, and most other people, Johnny, George, any of the mods, Valley of Despair. Remember VOD, write it down because that's where most people want to start to learn how to trade. So you then start to find yourself being competent. You're on the slope of enlightenment, to the plateau of sustainability. So guru here is a bit rich, but for me, I just always find myself on the slope of enlightenment, and somewhere between the plateau of sustainability. So guru is a wanker word. It's I'm a human. I eat, sleep, bodily functions like you guys, so there's no difference. So I thought I'd learned what I thought was a fair bit of information back in the day. So I was amazed at how quickly things I purchased appreciated. Everyone's a genius in the bull run. So then came the ass kicking I needed, and I realized that I actually had zero idea what I was doing. So that's the Valley of Despair. This is the best place you can be. It's almost rock bottom. So slowly but surely, I still find myself on the slope of enlightenment, and I always will be on. So the plateau of sustainability and continuing to find my way along my trading journey. I'm here to help others. Does it sound familiar? It's absolutely normal. Anyone who tells you they haven't been here is just full of shit. Behavioral biases. So we're nearly done, guys. We've been going for an hour and 15, so thanks for your patience. In my opinion, not only with trading, but in general, we as humans share one underlying aspect in the form of behavioral bias. So this can be described as irrational beliefs or behaviors that can unconsciously influence our decision making. And we generally observe two key biases in the form of cognitive and emotional. So below cognitive, it can be described as when decisions are made that are based on notional concepts that may not entirely be true, but are founded on strong beliefs. And then emotional bias. So it can be described as the emotions that one experiences when confronted with an issue, where the emotion is powerful enough for the individual to let the emotion overcome their logical approach. These are typically results of very personal experiences that influence decision making. So here's some cognitive bias examples. So confirmation bias. We naturally seek out the information that we feel that we can rely on based on our own predetermined conclusion or hypothesis. As an example, up only, Bitcoin to 100K. How many times did you see that? Bitcoin can't break this level because it hasn't before. It's just, it comes down to confirmation bias. The herd, the pack mentality. Get the tools from this course, go out and make your own opinion. Loss aversion. So again, we talk about the Valley of Despair. Loss aversion. Who's been riding this slope down here, hitting 90% loss, and then they start to get a bit worried. So why would I invest in that shitcoin for? It's only going to zero. So refer to SHIB and meme coins. And guess what they did? They went skyrocketing. So people have lost so much in the past, and I was a victim. That's probably a really sucky term to use, and I can't believe I used it, but I experienced enough in the bear market of 2017 and 18 to want to trade and pick myself up. So yeah, that is where people can certainly pick up a lot of bad memories from. Hindsight bias. So when we observe past major events as entirely predictable, but not the present one we're experiencing. So the 2017-18 bear market was so obvious, but the current crash from 69K to 36K was a black swan event due to X factor, which it really wasn't. It's just market movements and price going up and down. Emotional bias. So some typical emotional biases are described below. Overconfidence. So you've seen this one, Dunning-Kruger effect. Bitcoin will hit this level. It's already known, mate. So you get the smartasses out there who are like, market's wrong. Market's wrong if this doesn't happen. And it's half the time it's a joke, but people can take it seriously. Disposition effect. So where investors or traders, sell winners early, but hold on to losing positions. So how many of you have sold for a quick 2R? So you put $100 down, you sell, you hit $200, so you sell at 100 and you keep the other bit rolling. Well, in 2017-18, how many people do you reckon held on to 90% losses? And I did. I've had some coins and projects, whatever, that are just dead. But most people would have held on to these things because they had no experience, in my opinion, or they just had this disposition effect where they didn't want to hold on to the winners because it was too much to hold on to. They didn't want to see it keep going up and then potentially risk losing that money, so they sell it. But they're happy to hold on to these 90% losses. And again, I'm not immune to this, so just be aware of it. And then fear of loss. So it's different to loss aversion. Fear of loss is the emotional roller coaster you feel from not wanting to lose a trade. So I've entered a trade. I can't handle the pressure. I'm going to sell to lock in my gains. Again, you can overcome these things by having a trading plan. So again, I think this is where we're going to wrap up actually. So what is price action from an emotional perspective? This is from module 1. So do you remember this? This is 2017 here. This is just recent times gone. This occurs on the 1 minute chart through to the 1 month chart, to the weekly, daily, and anywhere in between. So my opinion that price action from an emotional perspective is based on and is the printout on a chart of every human emotion that is experienced in the market. Think disbelief, hope, optimism, belief, thrill, euphoria, complacency, anxiety, denial, panic, anger, depression, and disbelief again. That's all of these little fellows happening over and over again. The chart on the right will replicate to a certain extent from the 1 minute chart to the monthly and anywhere in between. This is why I feel price action principles work in any market. Humans are involved, and we are predictable in nature. So look, this is the wrap up. If you're asking yourself and wondering why we're not exploring a suite of information that leads to an enlightened path of trading glory, well, the truth is that this module has been designed in the sequential order to give you all the tools you need to manage yourself in any given trading situation. So my intent was that you would be getting warmer and fuzzier feelings the further you went into the course in understanding the simple way to manage anything in trading is to put things in place that help you overcome situations that only you can put yourself into, or that only you put yourself into. There are no market rugs that there's no market that rugs you. You rug yourself by allowing emotion to take you away from a path of logical reasoning. Shit happens. You push the button, you pull the trigger, whatever, you enter a trade and it sucks. You can't blame anyone else. But now you have the tools and the understanding to then go out there and form your own opinions and start your own journey if you haven't already done so. So now look, by understanding how to manage the below, this will now give you the freedom to enter and manage trades based on defined parameters such as your personality and trading time frame that best suits a trading style, risk management, trade entries, profit taking and stop loss management, leverage, liquidations, and journaling. So there are no more excuses. You now know as much as I do, as I've shared close to all of my knowledge. That's not a lie. Like you have now seen the majority of what I know. There are certainly some things that we can share and build upon further. I'm always still learning. The next thing for me is exo charts and things like that through Johnny as well. But yeah, I've given a lot here. So I really hope you find some value in this and that you can put it to good use. And one day we can catch up and have a beer, maybe. I'm always down for one. But look, it's up to you now. You've got to go get into it. Self-learning. So there you go. That's your whole module on how you can best manage you. You can now go and practice all of these things in the order they are arranged in this module. So start defining that edge of yours. Take these things seriously though, because the best offense is an incredibly strong defense. You should also place an extremely strong focus on learning how to lose like a pro in order to trade like a winner. We've covered it above. Cover your ass. Make sure your risk management is tight and no one can take that away from you. You've got 1% and you relegate yourself to 0.5% and then 0.25 and so on and so forth. You can't lose. You can literally find your edge within those trades. You can be in the game for thousands of trades with the original capital that you started with. The only reason you're going to lose extra capital is if you don't look after yourself. And remember what we say, you can't blame anyone else but you. So lastly, you should also try and help out others where possible. So come and join the Discord server where we can ask, or you can ask and take part in many questions and answers where over 2,000 people are now involved. It's free. This isn't a shill. Get your ass in there, join up, make friends, and I strongly encourage you to surround yourself with like-minded people. So that's the conclusion. This wraps up the Price Action Principles Trading a Range course in the written and lecture series. So we've got one module left to cover now, so I'm devising a way to get this across to you. So there's no point just copying all this information and then repackaging it into one book. Maybe we'll do that in the future, but it doesn't make sense for me now. So I'll let you know the best way to do this, and we'll share it soon. So we talked about doing some videos and that sort of thing, but don't forget, we've also got a trading competition to wrap the course up shortly with as well. So we're aiming for 3 to 4 weeks with that respect. There's a $100 minimum entry, and we will cover that in the not too distant future. So in the meantime, I just really want to thank everyone because as I've just counted, there are 298 pages of this course to date. So that includes the Excel journal, and it actually could be a book on its own, to be fair. So video wise, there's going to be about 4 hours of recordings to walk you through this. So each one's about 40 minutes. And then this one now is gone for 1 hour and 24, so that's killer. But there'll be these extra video modules, which will be half an hour each. So we have another 2.5 hours of modules to go through. So now look, we've ticked off all of these boxes. We've got still to go, tick, market structure, Fibonacci, order blocks, value area trading, ranges, liquidity and targets, trade management psychology, and putting it all together. That, my friends, is it from me. not forever, but I've spoken so much for the last hour and a half. My voice is going. Certainly need a drink of water, starting up some words here and there. It's a little bit late here at night, but I wanted to get this out to you. So please use this as you can. Do with it what you will. Share it, retweet, share your results, join the Discord, do whatever you need to do. But all I can say is 3 things I do repeat in life, and The Rock coincidentally says this as well, is go above and beyond, work the hardest in the room, and just be humble. There's no point being a dick about anything. It's help others and just be a general good person. So look, wrap it up. Thank you very much. Say hi to your mum for me. Look after your mates, and we'll chat soon. Thank you very much, everyone.